If you think option trading is only for the pros, or is too risky or complicated, this video is going to change that. Today I'm breaking down call options in plain English, showing you how they work, how people make money with them, and just as important, how beginners often get wrecked if they don't respect the risk. And stick with me to the end. I'll also cover the most common mistakes that beginners make and how to avoid them. Let's get right into it. What is a call option? First things first, what is a call option? A call option is simply a contract. You don't have to. It gives you the right but not the obligation to buy stock at a certain price, called the strike price, within a certain time frame. Think of it like reserving a deal. You're locking in to buy stock at a set price, even if that stock goes higher. But to get that right, you must first pay a small upfront fee. That small upfront fee is called the premium. Let's go through a real example with numbers. Let's make it real. Let's say Yelp is trading at $36 today. You buy a call option that lets you buy Yelp at $38 at any time in the next 30 days. And that option costs you 80 cents per share. Since each option contract is 100 shares, you are paying $80 for this contract. So how do you win? It's very simple. If Yelp stock goes up to $42, you have the right to buy it at $38. You could immediately sell those shares at $42, pocketing a $4 gain per share. But don't forget, you pay 80 cents per share for that contract. So your net profit is $3.20 per share, or $320 for the contract. That's the power of options. Small upfront costs with the potential of a big upside if the stock moves up in your favor. Now, this is the risk that most beginners miss, and this is where most beginners get burned. If a stock doesn't move enough, or worse, goes down, you lose your entire premium. If Yelp stays below $38 when the 30 days are up, your option contract expires and becomes worthless. You lose the $80 that you paid. Even if Yelp goes up a little, let's say to $37, you still lose because it's not above the strike price of $38, plus the premium of 80 cents. So if it's not above $38.80, you would lose and the contract become worthless. And that's why option trading is risky if you don't understand how time and stock movement works together. Now, these are some key concepts. Let's break down key things you must know before trading call options. Number one would be the strike price, the price you can buy the stock at. Number two is the expiration date, the deadline for your option to be profitable. Number three is the premium, what you pay up front for the option, quoted per share, but remember, in option contracts is 100 shares. And number four, the break-even price. That's the strike price plus the premium. In our example, that's $38 plus 80 cents. So that'll be $38.80. If the stock doesn't get above $38.80 by expiration, you lose and the contract becomes worthless. This is the bonus flexibility that most people don't know. Now, here's the cool part. Most people think you have to exercise the option and buy the stock, but you don't. You can actually just sell the option contract for a profit if the stock has moved up in your favor. For example, if Yelp jumps up to $45 halfway through your contract's life cycle, let's say 15 days within the 30-day contract, the option will increase in value, and you can sell the contract for profit without ever touching the stock. Kryptonite of it all is time. Time is your enemy. And a critical piece, time works against you. The closer you get to your expiration date, the less time your stock has to move. That's why options with more time cost more money. For example, a Yelp call option with the same $38 strike price, but 7 months to expiration, might cost $3.98 instead of 80 cents per share. More time, more flexibility, but also more upfront costs. And why beginners get wrecked. Here's why beginners mess up. They treat options like lottery tickets. They hope for a big move in a short time without a clear strategy. Professional traders use options as a tool for leverage and risk management, not as a gamble. They have a plan, they manage their risk, and they understand the math before they click buy. So now you know, call options can be a powerful tool, but they come with real risk that you need to respect. If you got value from this video, hit the like button, subscribe. If you want me to break down more option strategies like covered calls and cash secured puts, drop a comment below and let me know. You guys take care and see you in the next video.